John,
Merryn,
got a question for you. Where's the house price crash?
it's the question we're all asking. It's the question we all want to know the answer to.
You promised us a house price crash.
I think you'll find I didn't. I think you'll find I promised a healthy correction in real terms.
Same thing.
Yeah,
Same
just
thing.
about. Well, certainly that's what people take it as. Yeah, well, what can I say? The UK housing market is made of Teflon. I mean, it's down about 15% in real terms over the last year.
And that is a lot, actually.
Which is a lot.
It's a lot.
And to be fair, that probably is one reason why it hasn't fallen harder in kind of nominal terms. Because at the end of the day, real wages are going up. Big spike in inflation in wages means that affordability improves ever so slightly. But more importantly, nobody's lost their job and nobody wants to sell their house if they don't think they can get peak price for it. And so people are sitting in their houses for longer, and the people who want to buy them can't borrow quite as much money to get hold of them. Then you get a crash in transactions, which is what happened. But the deals that do actually go through for a bit less money, but not a massive amount less. And I guess the tricky thing, not the tricky thing, but the frustrating thing now for any first-time buyers out there is that, as we're coming into this year, mortgage rates they're a lot higher than they were kind of like 18 months ago, but they're not as high as they were maybe 6 months ago. And at the same time, kind of wage growth has improved. So affordability has improved. It's still, unbearable in lots of parts of the country. But there's no real trigger to kind of drive any forced selling, or to, the pressure we've seen, kind of like the maximum pressure on the housing market in 2023, and it's not as bad now. And chances are that interest rates are low. I don't think they're going to go much lower than they are now, mortgage rates, but at the same time,
they've gone down a lot. They've gone down a lot more in some other countries. Germany has had the worst of it, haven't they? We talked about German house prices a while ago, and they're down 10% there. And if you look at some of the others, I've just pulled up the numbers while you've been talking, because I got bored in the middle of you explaining where we haven't had a proper crash. Canada, Denmark, Sweden, Luxembourg, Korea, they're down 7% to 9%. Australia, the Netherlands, Slovakia, 3% to 5%. But everywhere else, prices only fell a little bit. And a lot of it seems to be about prices being propped up by rental growth, which I suspect is the case here. But then being pushed down again on the other side by regulatory change, which may again be the case here because we've got various rental reforms on the way.
Yeah, but I mean, the other thing with all of those markets is the interest rate sensitivity was higher than the UK basically for two reasons. It's like with Sweden, effectively, as soon as the interest rate changes there, the rate on your mortgage changes almost immediately. But the other thing is that anywhere that didn't have a house price crash in 2008, like Australia or Canada, the consumers, the households were massively over leveraged. They are where we were in 2008. Whereas one thing I think people don't appreciate, and we go on about it a lot in the podcast, is that after 2008, UK households, their balance sheets have improved, and we aren't as kind of, over leveraged as we were back then, which is the other reason that we're not as rate sensitive as we were. But I think that's why, the likes of Sweden, etc., have had proper crashes. And I mean, I'll be interested to see what happens to the Canadian banking system, for example. That's just off the top of my head. Haven't looked at it in any great detail, but you'd think with all those mortgages that are going to reset at scandalously high rates, etc., that there'll be a problem there. But overall, I can see there's a good reason why the UK hasn't quite gone the same way as those other countries, I think.
But we still got the lag. There's still a lot of people to remortgage. There's still a lot coming. There's regulation change, probably a new government at the end of the year. I'm telling everyone not to get complacent yet. John's crash may still yet come.
We need to know what we need to
see how I'm distancing myself from your crash.
Yeah, the one you tricked me into predicting.
Yeah. Now I'm putting myself out there as a housing bubble, a housing boomer, and you're going to take all the flack for the next however many years. Sorry, John.
I was going to see someone we should get back on the podcast at some point, or we should get one of the people that kind of talks about the 18-year housing cycle. Because if they're right, then this is the the buyer's remorse moment. in like 2026.
This is the last gasp.
Yeah, it's going to be when it all comes tumbling down. So I'd be genuinely curious to know what that kind of group of people think is actually going on just now. God, maybe I should talk to one of them.
Yeah, and now you've mentioned them, I'm almost certain they'll be in touch. Right?
It's like Candyman.
It is. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week we're bringing you a conversation with Oaktree Capital Management co-founder Howard Marks. Oaktree, founded in 1995 as a distressed debt specialist, now manages roughly $180 billion in assets. And Howard, as many of you will know, is famous for the notes that he writes on his thoughts about investment. Howard, thank you so much for joining us today. We really appreciate it. It's good to have you with us.
It's good to be here. Thank you, Merryn.
I wonder if we can start by talking about your sea change thesis and the ideas behind that. I think a lot of listeners will read your notes very enthusiastically and know a bit about the way that you're thinking, but some won't. So it would be great if we can set the scene by talking about this big pendulum swing that you've seen in markets.
Paul Samuelson, the great American economist who wrote the textbook that almost all of us read in college, said, "When events change, I change my mind. What do you do?" That's a good question. You know, most people kind of assume that the way things are is the way they've always been and the way they'll always be. And so the tactics and strategies that have worked will continue working. As simple as that, I think, for most people. The idea of the sea change arose for me 15 months ago. I wrote about it 13 months ago, and also 8 months ago, and also a little bit last month or this month. Mm-hmm. And I still believe it. And basically what it says is that at the end of 2008, the Fed took what we call a dovish, stimulative monetary policy to get us out of the global financial crisis. And in particular, they took the Fed funds rate, which is the benchmark rate of short-term interest rates in the U.S., to zero for the first time. Surprisingly, they kept it there for almost 7 years. And for the total of the 13 years, from 2009 through 2021, it averaged 0.5%. And the reason we watch the Fed and the reason the Fed manipulates interest rates is that interest rates matter a great deal in determining the vibrance of business. And the ultra low interest rates had a very strong impact on those 13 years. But I believe they're over. And that means that the climate ahead will be different from the last 13 years. Now, what prevailed over the last 13 years, not the way it's always been. At the beginning of my career, in the late 60s and 70s, we had a different interest rates. They closer to, I would say, 5, 6 on average, and we had a different climate. But then the U.S. had a bout of inflation in the 70s. The Fed funds rate was taken to 20 by Paul Volcker, the chairman of the Fed, and that killed the inflation. Good news. Killed the economy. Bad news. And it set the tone for the next 40 years. And I say in the memo, which I published in December, and by the way, everything I'm going to say about the memos is available via podcast if people would rather listen than read. In 1980, I had a loan outstanding from a bank, and I got a piece of paper which said the rate on your loan is now 22.5%. And 40 years later, in 2020, I was able to borrow at 2.5%. And that decline in interest rates really set the tone for that 40-year period. And again, I think that the decline is over.
In the latest note, you talk about reading Edward Chancellor's book. We're great fans of Edward Chancellor, and we've had him on the podcast in the past to talk about his books and his idea about that he had in his most recent book, The Price of Time. And we've talked about that with him a lot. And you say in your latest note that reading his book clarified your thoughts again about how it is that very low interest rates affect the investment markets. And again, you say in your note, and we've discussed here before, that there are all sorts of things that people attribute their investment success over the last 20, 30, 40 years to, in particular, their personal brilliance. But you also say that you think, in fact, it is very low interest rates that have been the main driver of investment performance of asset markets over the last 40 years. So it's very much the case that if that changes, everything changes. So I wonder if you could just explain what it was in Edward's book that clarified your thinking with the key points that came out there.
The reason I like Edward's book so much, Edward, as far as I'm concerned, is not an economist. I would say thank God, because I'm not very sympathetic to economists in general. Edward is a financial historian, and the philosopher Santayana said, those who are ignorant of history are doomed to repeat it. And Mark Twain, the American humorist of the 19th century, said history does not repeat itself, but it does rhyme. What does that mean? To not repeat, but to rhyme. And the answer is that the details of history are always different in every iteration. But there are themes that do rhyme from one iteration to the next. Edward does a great job of studying those and pointing them out. The first of his books that I read was Devil Take the Hindmost in the fall of 1999. Yes. And he described the behavior in speculative bubbles, things like the South Sea bubble of the 1720s, the tulip bubble. People engage in crazy behavior in speculative bubbles, and as a consequence, they buy things with no value for high prices, which is a good formula for losing a lot of money. And I was reading Devil Take the Hindmost in the fall of 99, and I said, wait a minute, this is the same behavior we're seeing today in what we call the tech bubble of 98, 99, 2000. And again, people acted like anything with internet in the name or anything having to do with e-commerce would make them rich, which of course is a very dangerous expectation. And so I wrote a memo called Bubble.com about the bubble that was taking place in .com stocks. It was, I don't like to be self-congratulatory, but it was right.
It was right. You can be self-congratulatory. Yes, that's okay. Particularly on this podcast, we celebrate success.
Well, and the great thing, Merryn, is that it attracted a lot of attention to the memos. I had started writing the memos 10 years earlier in 1990, and for 10 years I wrote without having one response. And as somebody who writes for a living, you would know that that's not very rewarding.
No, we don't like that.
But then thanks to Bubble.com, I was recognized, and nowadays the memos are popular. In 2023, I again spent the fall reading another Chancellor book, this time The Price of Time. What is the price of time? The price of time is interest. It's the amount that we pay to have the use of somebody else's money for a period of time. It's rent. We rent the money, and the person who rents the money out gets the interest rate, and the person who pays the interest rate and gets the use of the money gets the benefits of that money over that time, whether it be losses or gains. It talks a lot in the book about the negative impact of rates being too low. And I said, wait a minute, this is the same thing we're seeing now and have seen for the last 13 years. And so I wrote my memo called Easy Money, which came out a couple of weeks ago. And again, the same theme rhyming 400 years later. And it's important to understand the themes of financial history. It's more important to understand the way they rhyme and have a recurring impact on generations over time. And I think the impact of easy money, ultra low interest rates, is profound.
Yeah. So when you look at the list of things that you wrote in this memo, of the things that low interest rates allow, you make it easy to run a business. They make it easy for investors to see asset appreciation. They make it easy and cheap to lever your investments up, easy and cheap for businesses to obtain financing, and easy to avoid default and bankruptcy. And one of the effects of that is malinvestment, is capital being allocated to the wrong places, to businesses that shouldn't survive in a normal environment. So if we're now seeing this sea change and we're flipping back the other way, does it suddenly become hard to run a business, hard to make any money out of the markets, hard to lever your investments, hard to get financing, and really not easy at all to avoid default and bankruptcy? The flip sounds really nasty.
We had ultra low interest rates. I don't think we're going to ultra high interest rates. I think we're just going back to normal interest rates. So I don't think it's going to be terribly hard to make money or avoid bankruptcy or get financing. I think it's going to be normally hard. You know, the thing that people should bear in mind, both your listeners and normal economic participants, is it's not supposed to be easy.
So much nicer when it is, though.
Well, it's nicer for a minute, but the point of the memo is that it being easy subsequently has bad effects.
Uh-huh.
And let's think of an example. Investors like myself or you are supposed to be risk averse.
Mm-hmm.
We're supposed to dislike riskiness and be attracted to safety. And as a consequence, we demand the opportunity to make higher returns from risky investments. If we have two investments and one is safe and one is risky, we'll demand that the risky one appear to offer a higher return, or we don't make the risky one. We make the safe one. If I said, Merryn, I have two, Oaktree funds to offer to you. One invests in treasuries and it'll give you 7%, and the other is a venture capital fund that will invest in high-tech solutions. And if things go right, we'll make 7%. You'll say, I'll take the sure 7 over the risky 7 because you're a normal person. You're risk averse. You have to be induced to make risky investments. Now, what happens when people forget to be risk averse? And the answer is that they make risky investments without suitable incentives. Well, if the central bank reduces the interest rate to 0 and the return on savings, for example, is 0, as it has been most of the time for the last 15 years in this country, then if you see a crazy high-tech startup investment that offers 5, maybe you say, oh my God, that's nirvana. I'll take that all day long. I love 5% when cash is 0. And so you can see that ultra low interest rates on short instruments like cash or treasuries drives people to make investments in risky things that still offer low absolute rates of return, just higher than the measly, what I think it was Edward Chancellor who said the measly rates on safe investments. So you can see that ultra low interest rates encourage risk taking, and that's not good. It gets people into things they shouldn't do. And, the ultra low interest rate has effects on, let's say, people. It may not be people, it may be institutions or companies or what have you, but it has effects. And in particular, ultra low interest rates penalize lenders and savers and subsidize risk takers and borrowers. And, is that what we really want to do in our society? Let's say you have a worker who's been fortunate enough to save up $500,000 over the course of her career, and she's now retiring. If the bank offers 5% interest, which is pretty normal in the U.S., she makes $25,000 a year of retirement income. But if the interest rate is 0, as it has been most of the last 15 years, she makes 0. And she says, I can't live on 0. Most people can't. And so she says, well, I better invest in, high-tech stocks or something like that. And it's probably inappropriate for her to be investing in something that risky, given her limited resources and station in life. But she does it because the low interest rates drive her out of safe instruments. And, I in the memo, I quote my late father-in-law, who used to refer to people like her as handcuffed volunteers. They do not what they want to do. They do what they feel they have to do.
Oh, what they're forced to do by the central banks, which gives our central bankers a level of responsibility I'm not sure they always step up to.
They may not sit down and say, let's penalize the retiree and reward the speculator, but that is the impact of what they do. Maybe it's a byproduct of having a stimulative monetary policy, which with low interest rates and high availability of liquidity. But whether it's their intention or not, it is the effect.
Well, they don't do it unknowingly, that's for sure. So there are, in that sense, there are many positives to a return to a normal level of interest rates. And I know there is a view that we will see interest rates go back down to what younger people consider to be normal, back down to, very low levels as inflation falls back to 2%. But my view, and I suspect yours as well, is that they will stay at much more normal rates in the medium to long term.
Yes, in the memo and in the podcast, I take the position that the rate for the next decade, shall we say, is on the Fed funds rate, which is always the lowest rate there is because it is the rate that banks pay each other or are paid on bank deposits at the Fed, that the rate will be between 2 and 4, not between 0 and 2. And I don't believe in forecasts. I especially don't believe in my own forecasts, but you have to believe something. And, I don't think it's heroic to cite such broad ranges, but I think that's true, and I think it's indicative. It's going to be a different climate. It calls for different actions.
And it's fair to say, without making forecasts, that historically it's incredibly unusual for inflation to get to the level it did and for it then to fall back to 2% and remain there. That would be, if we're talking about history rhyming, that would be history not rhyming at all.
Right. Look, we haven't had high inflation much of the time since 1980, and we got up to 9.5 in the U.S., and now, as you say, it's around 3 or 3.5, and most people are confident it's going to be 2. The Fed has adopted restrictive monetary policy to cool off the inflation. It doesn't want the economy to overheat and be inflationary. So they raised interest rates and embarked on quantitative tightening, taking liquidity out of the system by selling bonds into the economy or merely letting them mature, both of which use up liquidity like a sponge. And so all the optimists who've been raising the stock market for the last 14 months say, oh, you know what, inflation will soften. That means the Fed will not have to raise rates anymore. They'll be able to start lowering them. That means that it's not going to cause a recession. I think you would say, Merryn, Bob's your uncle, or Robert's your mother's brother.
I would say that. It's exactly what I'd say. But listen, there will be a lot of positive effects here, right? And one of the things that has been irritating for everybody, anyone with a vague value slant anyway, over the last decade has been watching companies expand into areas, for example, that they're not expert in, moving away from their core business, getting what you might call a little flabby. And with interest rates coming back to normal levels and capital not being so cheap and available, you might expect to see companies behave in a more productive and a more efficient way. And perhaps, John, who is often on this podcast with me, we were talking about this earlier, seeing various companies beginning to go through layoff programs, which of course is unpleasant in some ways, but necessary in other ways, and pulling back from businesses that aren't their core area. And this would seem to be long-term a good thing, in particular for productivity.
No, I think that's right. The companies should stick to what they're good at rather than expand into new areas. And they should take prudent financial actions rather than risky. And the only thing that ever makes them do that is fear of complications. I said in one memo back in, I think, 2020, that fear of bankruptcy is to capitalism as fear of hell is to Catholicism. It is fear of bad outcomes that keeps participants in the economy and the markets on the straight and narrow. And when people believe that the interest rates will always be low and the central bank will always bail them out if necessary, that permits or encourages risky behavior, which is not good for society. And when risky behavior is when behavior is too risky for too long, then you get a bubble. And when you get a bubble for too long, then you get a bust and a crisis. So, these are these extreme behaviors that produce extreme outcomes, and everybody likes a good bubble because most people make a lot of money, but nobody likes a bust and a crisis.
Yeah, that brings us very, very neatly to private equity. And one of the things that you say in one of your notes, I would venture that nearly 100% of capital for private equity investing has been put to work since interest rates began their downward move in 1980. Now, back to what people have been telling us over the last couple of decades has been driving their success. And private equity is the obvious example here of a group of people who constantly tell us that their success is based on skill, on being able to take companies, improve them, make things better, and sell them on because they are fundamentally worth more. And as time goes past, it's increasingly obvious to those who hadn't grasped it previously that a lot of that success is based on the manipulation of debt, as opposed to manipulation of cheap debt in particular, as opposed to on this special management skill. So what happens to that now absolutely huge sector in this sea change?
You talked, and I think in the second question, you talked about a tailwind, or a benefit that has been behind investors for the last 40 years. And that tailwind, of course, is the decline of interest rates and the low interest rates. And I thought you were going to say, Howard, what is that tailwind? I think you said I use an analogy, a metaphor, or whatever your English teacher would say is the right word. And that metaphor, of course, was the moving walkway at the airport.
Yes.
And I believe that low and declining interest rates have given investors, especially private equity investors, the tailwind of being on a moving walkway. And you go to the airport and you stand on the moving walkway, you do okay. But if you walk at a normal speed on the moving walkway, you make very quick progress, and you say, "Boy, I'm really fit." And in the same way, and if the listener wants to understand what I'm talking about with the impact of low interest rates, try this. So you're in your office, you're a private equity mogul, and you find a company, and you say, "I think if I buy this company for X dollars, I'll make 10% a year." And you're interested in doing that. You consult your investment banker, and she says, "I can get you the money at 8% a year." And you say, "Oh, great, I can borrow at 8 and invest at 10 and make 2 for nothing." And then, of course, if you can add the value to the company, you make even more. So I do it. But then the central bank takes down the interest rate. Now, reducing the interest rate makes a company more valuable, because a company that produces a given stream of cash flows, which in this case was postulated to be 10%, those cash flows become more valuable. People who see interest rates at 4 or 2 or 0 say, "Man, I'd like to have something that cash flows at that rate every year." So the value of that company goes up. And rather than make 10% a year, you make 12, because the asset appreciates. And then the borrowed money, which you thought was going to cost you 8, only costs you 6. So rather than borrow at 8 and invest at 10, you end up borrowing 6 and invest at 12. And you say, "Boy, I'm smart." But it wasn't really the moving walkway. So as I said, and you quoted, the private equity industry really was invented in the 80s. And as I mentioned, rates have come down from 20 to 0 over the ensuing 40 years. So, and I just described the benefit, the impact of low interest rates. So that means that the private equity industry really has only existed in this period of declining or ultra low interest rates. People may think that it was their genius that made them fortunes in private equity, but maybe it was the moving walkway of rates.
And if the moving walkway judders to a sudden halt, perhaps they all fall over.
Yes, there you are. To be completely accurate with regard to private equity, there are 4 ways to make money as a private equity investor. Buy companies at bargain prices. Lever up your purchases with low-cost borrowed money. Add value to the company by improving its operations or its management. And then sell the company at a higher valuation in the end. 4 ways. But if interest rates are declining, you don't have to buy bargains. You can pay full prices, because tomorrow they'll be higher. You don't have to add value, because the return from just the levered purchase will be good enough. So if all you have to do is buy, borrow, sell, and you can surf on the market trends to do those things, you don't have to make genius decisions.
Do you think that the boom in ESG is also somehow a function of low interest rates?
I never thought of it. Yes.
Well, in that it gives, the abundance of easy money and cheap capital gives people the luxury to focus on things that might not previously been part of their core.
Well, that's one way to say it. Another way to say it, Merryn, might be that the tailwind of declining interest rates tends to make investing successful. So people can invest in ESG, put an overemphasis on ESG, and do very well financially, and think that the two are linked.
So we may see something of a sea change there as well now.
Yeah, well, again, I'd have to think it through, but it certainly seems possible.
Can we go back to the pandemic?
I'd rather not.
And
I'd rather not.
One of my not in that sense, but even you had a nice time with your son Andrew in the pandemic, right? And you wrote a really lovely memo about your conversations with him, which I enjoyed enormously. And I enjoyed it in particular because I'd actually written a column at some point long ago about value and growth, and saying that really we shouldn't divide them up, because there is only value investing, because nobody buys something if they think it doesn't give them value. We just disagree about what represents value, right? And I think that was roughly the point that you were making. We're all looking to discount future cash flows. We just have different ideas about how far out they should be and where they come from, et cetera. So they're kind of the same thing. But in that, one of the things that was interesting was I felt you softening slightly towards cryptocurrencies, Bitcoin, very high growth tech, et cetera. Has that stayed with you, that softening towards crypto?
Well, again, Merryn, kind of what I said about business, the business environment. I'm not positive. I'm only not so negative. As Merryn says, my son Andrew, who's a venture capitalist, and his family moved in with us during the pandemic. And we spent a lot of time together. And of course, that resulted in investment, should we say discussions, or should we say arguments. And he's a very good thinker. And he said, Dad, this dichotomy between value and growth is a false one. Everybody wants growth and everybody wants value. But the question is, where do you think it comes from? One way to make money is to buy a company today, which is actually worth more than everybody thinks, and to take advantage of that discount. And that has come to be described as value investing, take advantage of momentary underpricing. And another way to get value, as you say, Merryn, is to buy a company today whose earnings will be 10 times higher in 30 years. And that pursuit has come to be called growth investing based on a high rate of earnings or cash flow growth in the future. The formal investing world did adopt that dichotomy, and Andrew argued that it's a false one. And by the way, it is true that one of the worst things you can do in some way is to say we do this and we don't do that, because the investment world is very fluid and the investor should be somewhat fluid. And I argue to this day, we had this discussion 2 weeks ago, that there are people. Not everybody can do everything, and not everybody is equally good at doing everything. So there are some people who are very good at ferreting out current underpricings, and there are some people who are better than others. I don't know if anybody's really good at it, but there are some people who are better than others at knowing or sensing what high-tech companies will look like 30 years from now. So some investment situations derive much of their value from their current assets and cash flows, and some derive more of their value from a high rate of growth in cash flows and earnings over the long term. And so obviously the people who are good at the latter should do that, and the people who are bad at it shouldn't do it. You know, ironically, one of the, I know you wanted me to talk about crypto, but
I know, and you're just not picking it up.
You got away. You know, ironically, I was going to say the greatest bubbles we see with the greatest consequent losses occur when people overstate the far distant increase in cash flows. We had the tech bubble in 2000, and we had the bubble in the Nifty 50, which I also was privileged to live through in 1969 or 73, depending on when you want to date it. So every once in a while, people say, well, I've changed my mind. Trees will grow to the sky, and I'd like to buy one today as a sapling. And usually it turns out that trees don't grow to the sky, and doing so-called what they call growth investing turns out to be a mistake. So Bitcoin. Well, Andrew who was more neutral, or positive actually, to Bitcoin in 2020. And by the way, it did great. I can't say it didn't. He bought it, I think, 4,000 in March of 20, and it went to $70,000. That's pretty good. And even today, after being wrung out, it's still 43,000. But he convinced me with success that I shouldn't opine on things I don't know anything about. And when I came out extremely negative on Bitcoin, it was 2017. I really didn't know anything about it. And he said, "Dad, you've done very well in your career coming out against styles that have no substance. And so one develops a knee-jerk reaction and says, oh, there's one, I'll come out negative against that one." Well, you shouldn't do it without investigating thoroughly. That was his point. But my point is this, Merryn, there are two kinds of investments in the world, broadly speaking, not growth and value. There are two kinds. The ones that have intrinsic value that you can calculate and buy on the basis of a discount from intrinsic value, and the ones that don't have intrinsic value that can be calculated. So what has intrinsic value? Stocks, bonds, companies, buildings, all have intrinsic value. And you can look at a piece of land for farmland, and you can say, well, that acre will produce 10,000 in cash flows in the next year in terms of its crops, and it's worth 50,000. That's the intrinsic value. That's a great thing to be able to invest on that basis, and that's basically what I do. But there are things that don't have intrinsic value, mainly because they don't have cash flows. And what are those things? Gold, diamonds, art, furs, oil. People say, well, oil is going to go up, oil is going to go down. What is the intrinsic value of a barrel of oil? The answer is you can't calculate it because it doesn't have a cash flow. And then, of course, the other thing that has no cash flow and can't be calculated as an intrinsic value is Bitcoin or crypto. It has no intrinsic value. It's only worth what people will pay for it. And, if you buy it and you put it in the drawer, at the end of 10 years, it'll still be sitting there, but it won't have attracted any cash flows, any dividends or interest. So making money in cryptocurrency is only a matter of appreciation in price, but appreciation in price cannot reasonably be predicted for assets that don't have cash flows. That's the bottom. For me, that's the bottom line. So you can invest in crypto because it's fun, or I wrote a memo about gold 12 years ago called All That Glitters. You can invest in gold kind of out of superstition, and people have been doing that for
Howard,
centuries.
would you take gold over crypto or crypto over gold if you had to?
No.
If you had to choose one, which would it be?
Yeah, I mean, look, I think, if I say I tend to say yes, but Andrew would kill me because they both have limited supply. The amount of gold you can get out of the ground is limited, and the amount of Bitcoin you can mine is limited because by the algorithm to a certain number of coins. I think it's 21 million. Gold is a little more tried and true, but it also lacks any kind of analytical raison d'etre.
Yeah. I'm gonna put you down for gold. I'm gonna put down for gold. And then everyone will get irritated with us if we talk about this for too long. So can I move on to asking you then about, at the very end of your last memo, you say, if you agree with me, which of course we do, we have a host of solutions to propose. So if our listeners, ordinary retail investors out there right now, looking at their portfolios going, I've listened to what Merryn and Howard are saying, I'm a little nervy, what am I going to do with my money? And one of the things that you said recently, and I know you didn't mean it to people to actually go out and do it, was, sell everything, buy bonds. What would you tell the ordinary person to do now?
Look, the upshot of the whole thing is that when interest rates were at zero, things that pay interest were not rewarding. And now the interest rates are a few hundred basis points, by which we mean a few percentage points higher. The returns are substantial. And whatever you had in what we call fixed income, bonds, notes, loans, however you fixed income, credit, whatever words you want to use. Whatever you had 4 years ago, you should have more now. Then it was puny. Now it's substantial. 2 years ago, high yield bonds, which is one of, that's what I cut my teeth on in 1978. I started Citibank's high yield bond department. 2 years ago, high yield bonds paid 4%. Not very attractive, especially given that some of the companies are quite risky. Today, they pay 8%. Well, if you had any at 4, you should have more at 8. If you didn't have any at 4, you should have some at 8. So there's an example. Fixed income securities offer substantial yields today, and the return or yield on a fixed income security is virtually by definition safer than it is on an equity instrument, a stock. And so people should own some today. Today you can get a very suitable return with decent safety by going into, for example, a high yield bond fund.
Howard, thank you very much. Incredibly kind of you to be with us today.
Well, it's a pleasure always, Merryn. Thank you.
John,
Merryn.
You listened to that interview, right? You listened to me talking to Howard. We had a great chat. I really liked talking to Howard. What did you think?
Oh, I mean, Howard's great. He's up there with Jeremy Grantham on my fanboy list. It's kind of like one. I think, we get piles and piles and piles of stuff to read, and his memos are basically among maybe 5 people's things that I make sure I just read them every single time they come in. Part of that's confirmation bias, because it's nice to hear someone who's acknowledged as a highly successful, intelligent investor basically saying what you would like to say about interest rates and things like that. But it makes a lot of sense, and it's also the fact that he is obviously an older kind of guy. He's been around. He, started his career kind of around about the same time as people like Bill Gross and all the rest of it. So they've seen this long bull market in bonds and interest rates, and they're aware that big things do sometimes change. And he's not somebody that makes a lot of predictions at all. That whole sea change thing he was talking about is quite an unusual thing for him to just turn and say, actually, I specifically think that this is going to happen and that this is not going to happen. So I think that's also another reason it's worth listening to. Yeah,
I read his memos religiously as well. And we talked about that one that he did with his son Andrew, and it was fascinating because, well, a lot of, if you go back and read it, a lot of it turned out exactly as these things normally do. A lot of the things that Andrew was saying turned out to be bubbly things to say. There's no price at which you might sell this or that, etc. But what they showed was the open-mindedness of long-term successful investors such as Howard Marks. So instead of just saying, well, this is the way I do stuff, this is the way I've always done stuff, and I dismiss anything else, he's open. I suppose you have to be open-minded if your son comes and lives with you for a couple of months. No point in being closed-minded, right? That's really going to make dinner unpleasant. But I liked the way he had these very open conversations with his son, and their very different styles of investing, and how his thought process evolved as a result. He talked about Bitcoin having no intrinsic value, for example, but he at the same time wasn't actually down on Bitcoin.
No, he wasn't. And I think I feel slightly less, what is it? I basically agree with him. I take his point. I'm still more inclined to gold than Bitcoin, but I do see that Bitcoin has got, a kind of purpose and a kind of some sort of value. I just don't know how you would go about thinking about that. And the difference is that gold's got a long-term track record, so you can actually have some idea whether or not it's expensive relative to at least to its own history.
I do think I eventually bullied him into choosing gold. Do you think I got there in the end? I think I can put him down as gold over Bitcoin. You think?
Oh, I think so. I think, but in a way that was interesting in itself. It's that thing. Like our pal Charlie Morris, I think, would be very, very pleased to hear, Howard Marks saying that basically gold and Bitcoin are kind of, sort of, almost the same thing It's just that one's kind of old school and one's newer. I still struggle slightly with that idea. But I mean, the other thing I would say, obviously, is that, Howard's like a bond market specialist. So at the end of the day, I'm sure he kind of takes a curious interest in something like gold or something like Bitcoin, but he probably thinks they're both basically novelty acts. As a bond guy, he is into, cash flows, creditworthiness, all of those kind of good things. And I don't, even when it came to equities, he wasn't, it's kind of like, well, that's not really
not my area.
Thing. Yeah.
Yeah. There's me trying to get him to say buy UK equities. I couldn't quite get him over the line. Could I? Thanks for listening to this week's Merryn Talks Money. We'll be back next week. In the meantime, if you like our show, rate, review, and subscribe wherever you listen to your podcast. And of course, do tell your friends. Thanks to all of those who've been commenting and emailing John ideas for shows. We are taking note, and we'll have show email live soon, so you can email the team directly with your suggestions and, of course, your complaints. There'll be a special hate mail section. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi, additional editing by Blake Maples. Special thanks to Howard Marks and John Stepek. Be sure to sign up for John's daily newsletter, Money Distilled. The link is in the show notes. So we'll also put in the show notes, by the way, a link to Oaktree's website, so you can go and read Howard's notes directly.